Hey everybody. Well, let's get started. Al and I are here for our Spring 2024 Market Insights in Sustainable Investment Trends webinar. Thank you guys for joining us. We're proud to say we have the biggest attendance we've ever had for one of these webinars, so we're really excited to be here with you guys. So I just want to quickly introduce myself and Blue Summit for anybody who doesn't know us and our firm. We are Blue Summit Wealth Management. Alan and I are the presenters for today, but there's much more to our team. We are celebrating our 30th anniversary this year, which we're very happy to say. And our mission is to help clients align their environmental and social values with their investments. So I'll go through some quick house rules for the webinar, and then we'll jump right into it. So if you have any questions, please enter them in the Q&A box that you see at the bottom of your screen. We will try our very best to answer any questions that come in today, but we do have a pretty packed deck of content. So if we don't get to them, we will try our best to answer you directly after the event. So let's get right to it. Alan's going to start, and we're excited to share this content with you tonight.
Yeah, thanks, Robert. So a couple months ago, we had a market update as part of our webinar, and we had a lot of good feedback. People were really interested in hearing this. So we're going to make this an ongoing thing. And as part of the RSVP process, we did request questions from all of you, and we received many of those. So both of us have folded those into our presentations, the questions we received at the beginning. So we'll try to get to all of those. And then if there are additional questions during the live presentation, we will definitely be following up with you individually afterwards. So hopping into the agenda for today, we'll start with that market update. People are interested in, what's going on with the stock market, the bond market, interest rates, particularly this year because it's an election year. So I'll focus on that specifically. And then we have a few questions around, what can we be doing? What are some new opportunities? And as part of that, I'll discuss, cash that folds in with the interest rates, and additional new opportunities that we've been using with clients. Maybe they're new to you. Maybe this is an introduction, and then that would spark a conversation for a one-on-one discussion with Robert or I. So market. It's actually been a pretty good year. So we're, 5.5 months in. These are different indices that have, different types of stocks, whether they're domestic or foreign. This is last week, and then this is the year to date. So just at the top, everyone's familiar with the S&P 500. I like to look at other indices as well. So for example, small cap, the Russell, international. It's pretty wild, but the S&P 500, as you may know, is dominated by a few of the largest firms in the world. NVIDIA, Google, Apple, they're making the highlights. They've been referred to as the Magnificent Seven over the last year or so. So they are really driving a big part of the returns over the last, say, 18 months. But also that gives you a lot of risk if you're only invested in the S&P 500. So those 7 firms represent almost 1/3 of the 500, the market cap of the 500. So 1/3 of the 500 market cap is 7 firms, and 2/3 is 493 firms. So we, as part of the investment management process, wage that risk return. And you might see, more value stocks right now, with growth having grown so much over the last 18 months. We have more of an international exposure than just domestic. And then a quick comment about the bottom here on bonds. When interest rates go up, that means bond pricing goes down, right? So interest rates being high, driven by the Fed, which I'll talk in more detail about, has really impacted the performance of bonds. But this is kind of what we expect. We have diversified portfolios because typically the stocks and bonds move in an inverse correlation with each other over, multiple years and decades. So when one is up, the other one might be down. That way we want to have a little bit of both, maybe some real estate, and then some of the alternatives that I'll speak about as well. And really this is what I would expect in a higher interest rate environment. Bonds would be down. If the Fed decides to start lowering rates, bonds could, shoot up. Basically, a whole year's worth of a typical bond return could happen in a few weeks if interest rates start to go down. Well, I'll talk a little bit more about interest rates and expectations as well. So, quick look, there's some numbers here. This line chart is maybe a little bit helpful. Again, this is 12 months versus just year to date. I don't even like to really look at year to date. Maybe if we're in December, that's 12 months, but really you should be looking at 12 to 36 months for a minimum to measure, performance and the market, because, month to month is totally unpredictable. I'll explain, why. We'll look at some earnings, but our economy can be doing well, earnings can be doing well, and you could literally have a piece of news, whether it's from the Fed or geopolitics, that can move the market, several percentage points in 1 week. So again, this is a long-term investment, S&P, Russell 2000, we could talk about all of them, but for today, I wanted to highlight where are we over the last year or so, and then also talk about that concentration of, the S&P 500, this being driven by a few firms, which we do have exposure to, but I wouldn't say it's overweighted exposure. Therefore, if we see a downturn in something like NVIDIA, which has, been moving around over the last few weeks, we wouldn't have an oversized position there. I mentioned earnings. So, we always talk about stocks, but what is really, a stock? It's a company that's making profit, and we're participating in that profit via dividends and the growth of the equity of that company. So the main thing that we look at, and what usually drives stock prices over the long run, is earnings. This last quarter, so this is a Q2 update for earnings through the end of March, did very well. This has actually been going on for quite a while. The news might be saying, the economy is not doing so well. Well, unemployment is really low. Companies are making really good profits. So I would expect that, we would have seen what we saw in the last few months, 18 months for the stock market, because the companies are making money. On the far right here, you can see the surprise. So the surprise just means, what did the analyst expect? And then over or under that. So if the analysts were perfect, the earnings surprise would be 0. This has been really good. The earnings have come in above expectations for the last quarter. It's a little bit of a surprise, and that's why we call it that. I continue to be bullish on the economy and the companies here. We'll talk about, some other factors like election, et cetera. But the main thing I wanted to point out with this slide is that the companies that we're invested in are profitable and they're making money. That goes, for the average overall. I'll pivot a little bit to interest rates, because that's a really popular question, whether from our RSVP process or just at the dinner table. And it's interesting because, the market has been predicting that we were going to lower rates a long time ago. That didn't happen. This chart, I'll just try to briefly explain, is basically where did the market think, these dotted lines, where did the market think that the interest rates were going to go? And then what actually happened is the dark line. But it's also really funny here because not only was the market wrong, but the Fed itself was wrong in their messaging. So the dot plot, the dots here are actually what the Fed said they were going to do on the bottom here. And then the dark line again is what they did. So even their communication has been inconsistent with actually what's been happening. You can take that back all the way to, transitory inflation a few years ago when they said we were going to have a few months of inflation. Well, that ended up being this big ramp up in interest rates. And then we said, okay, we're going to drop rates. Powell said that around last November and the market rallied. Well, we're still flat with interest rates. So what do we do about it? The main point here is we watch what they say, watch what they do, not what they say, right? So until we actually see an interest rate reduction, all that we're, seeing, we're going to go with what they're doing. So, Powell's maybe signaling, but this process is taking a lot longer. Therefore, what are we, buying high quality debt positions? We don't want to be in companies that are stretched when interest rates are very high, because then that's when they get in trouble, right? They can't service their interest rate. And then we have, growing position to floating rate returns. I'll speak to that, with the alternatives. Floating rate just means a variable interest rate. You might have heard about that, when people were getting mortgages, sometimes they're variable, sometimes they're fixed. In the company space, rather than in your, home mortgage, floating rate is actually a bit more common, whereas, your 30-year fixed home mortgage is more popular, right? And then one comment that might require some follow-up for those of you that have individual bonds, with us, because the price of the bond has come down, and this might be just too confusing, so we'll talk about that individually if you'd like to follow up. Because of the price of the bond has come down, you might see an unrealized loss in your account, but we're holding those individual bonds to maturity for the vast majority of the time. So what will happen at maturity is you'll get all of that money back, whether or not you see an unrealized loss. And I think that's important to point out. A couple points on the election year. So it's always over the news. It's the biggest seller of commercials for this entire year. But does that drive our stock performance? And the couple slides here of should you be invested? What if Trump gets elected? What's happening with Biden? The whole point here is whether it's Democrats or Republicans, it's that the time in the market, this green line, if you're invested for both Republican and Democrat presidencies, is much more, you're much more value than if you said, okay, I'm only going to invest when there's a Democrat in charge. And that's because, the politicians can create headwinds or tailwinds to the process, but the underlying companies, Apple, Google, they're still making iPhones, they're still making revenue and earnings, and we are taking a piece of that. That's really our goal. And then how do election years stack up? So all years, this is an average stock performance return for US stocks. All years are going to do around 10%. This goes back, I think that's 1926. Yeah, exactly. 1926. It's a little confusing now. We should have 4 digits there. But all years around 10%, non-election years, and then presidential election years. So we're in this right here, a little higher than average, but you shouldn't think of it as, I need to get out of the market for this year. I have no idea what's going on. We just want to stay in the market, and that time in the market is the most important. And then just another slide on election year, but I'll move forward to new opportunities. I just have a few more minutes here. So what are we doing for new opportunities? I've mentioned to many of you private credit, that's that floating rate. So when the banks started to pull back from investing, which is happening, for the past few years, well, who's filling that void? It's people like us. So it's our money. So we're lending money to companies now through an intermediary, and we're taking 8, 9, 10% because that's where the interest rates for these companies are. Those are like equity returns. So we've started to put a bit more money into private credit, and I'm going to keep doing that until we see the Fed dropping interest rates significantly, which I don't expect to be this year. We're going to do, follow what they do, not what they say, right? So we're going to be in private credit for quite a bit longer. Private equity is new. It's important that we have one-on-one conversations if you're interested in any of these, because some of these are only for accredited investors, but private equity is really ramping up in our space. We've been doing real estate for quite a while. We have a renewable energy investment that some of you are in. It's basically a renewable energy utility. So it's not, buying solar panel stock. It's actually solar and wind selling to utilities like SDG&E. So very stable earnings, therefore very stable dividend pass through to us. That's the goal of that one. And then, the vast majority of our money at Blue Summit are in the models that we manage internally. And those are managed on a day-to-day basis, primarily by myself, but, with our whole team in mind. And those are not things that you should have to worry about talking to us about. We're just taking care of that. That's our job. That's part of what we're getting paid for. Just, one quick thing on private credit I mentioned. SOFR, it's basically base rate, we used to have LIBOR. It's basically, what are banks lending to? So in 2023, we're seeing LIBOR, which is, SOFR around 5% plus almost 6%. So that's what I was saying, total return right now in 2023 for this private credit is sometimes north of 10. I don't, promise any returns, right? But this is what we're targeting. Whereas in, 2020, we were targeting 5% and typical bonds were paying 2 and cash was paying 0. So, just a comment on cash. If you have large cash positions and you haven't set up an IFI account with us, I definitely recommend that. It's something that we can help, but really you manage your cash yourself. It's a high yield savings account. You link it to your bank account. You can move it back and forth really easily, and it's paying over 5% right now. There's no reason to have a significant amount of cash sitting in your checking account, beyond what you need. For living, you can have, your savings account in something that should be making 5%. So just do a check on that while interest rates are still high. It's worth the time. So I made it. All right, 16 minutes, 1 minute over, but went through a lot. Again, questions, please reach out to me or the team, whatever you think is most relevant directly. And Robert's going to take us through the socially responsible angle of our business and some updates there.
Thanks, Alan. Hang on, everyone. I just have to share my screen now and do a quick swap. Right on. Okay. In audio, video, good. Sorry, I can't see the screen anymore, but
yeah,
all right.
We've got you.
Okay, sounds good. Yes, thanks, Alan. That was wonderful on all the econ and market insights. So now my portion is going to be focused on the sustainable investing part, which is the other half of what we really do for clients. So I'll start off with the first 4 slides are going to be really primers on this topic, just to make sure that everyone in attendance is on the same page about what is sustainable investing, and we'll get into the juicier stuff later. So first of all, for some of those who have been with us for a long time, you may know this as SRI. We toss that acronym around. You might see ESG in the news a lot. Sustainable investing is a term that I personally prefer. I think it's just the most all-encompassing. Essentially, they all have a very similar goal, and I've just stated that very simply here, and that is it's an investment approach that values and incorporates environmental, social, and corporate governance factors alongside financial data. So you'll often hear these referred to as ESG, and that's exactly what they mean. This next slide, I think, is really important to point out that there are a lot of people working on creating standards for this space. It's a very broad topic, so I think by nature it has taken a lot of work to even get where we are. I think the best analogy for creating standards and frameworks for this type of thing is just looking back at financial accounting standards and how current day we've got very clear standards on how companies should report their earnings, income, debt, liabilities, everything so that anyone from the outside can get a uniform assessment on many, many different companies that are across many different situations. So think about sustainable investing similarly, that there needs to be some sort of baseline standards so that metrics can be accounted for and that they can be consistent across the board. So on the screen are just a few organizations that contribute to this space a lot. There are many, many more. These organizations operate in Europe, all around the world, but really the inception of these standards and frameworks was in Europe, which I think is interesting. They've kind of carried the torch as far as being progressive with corporate responsibility. One of the biggest challenges in this space is how to incorporate ever-changing issues into the sphere of sustainable investing. Sustainable investing now looks different than what it did 20 years ago, and new issues have come up that are being incorporated. So guaranteed 20 years from now, there will be things that are baked into this process that are different from where we stand today. So I think it's just important to recognize that there's a lot of effort and coordination around the world that has brought us to where we are. That brings cohesion to the industry now. and gives us lots of clarity to move forward with a more clear purpose. So what is sustainable investing? How does it get implemented? So I like to call this the 1, 2, 3. So number one are exclusionary screens. So I've just put some logos that will probably shock a number of people. These are the types of companies that immediately get excluded and don't make it into consideration at all. So your big oil and gas companies, your tobacco companies, your gun companies, your military weapons companies, your coal companies. So all the major offensive industries are immediately excluded. The next step is what's called ESG integration. So we talked about ESG. There's a bit more of a breakdown on some of the criteria that fit into the E or the S or the G, but essentially each public company will have these metrics assessed and measured and put into an ESG profile. And those are then looked at and integrated into the company right alongside their financial data for mutual fund companies to decide whether we include that company or not in the portfolio. So when you look at all that data together comprehensively, that's called the integration part. And number three is shareholder advocacy. I have a number of slides that dig deeper into that, so I'll touch on that shortly. I want to take a quick diversion and just talk about sustainable investing and returns at the beginning of my part, because it's a very, very common question. People ask, do you need to sacrifice returns to invest in this fashion? And the simple answer is no. There's lots of research going back decades that shows that sustainable funds perform at or potentially above traditional funds. Of course, like Alan said, there's never any guarantees with anything, but there's been lots of research that shows you don't have to make a trade-off. So now we'll go back to shareholder advocacy and what that is. This is something that we feel is the single most impactful part of investing responsibly, and using the funds that we use for you guys being invested in that way. So what is it? Shareholder advocacy means using your voice as investors to drive responsible risk management and spur positive change in corporate policies, processes, and products. It's about standing up and telling companies to do better. It's a pretty funny cartoon because it makes it seem like this process is very adversarial. And I think in the past it was that way, where companies did not want to hear from shareholders. They didn't appreciate the comments that they had about trying to be better. But from my research and talking to fund companies day in, day out over ever since I've been with Blue Summit, coming up 10 years, one of the most interesting things is that these corporations are much more friendly to these conversations. They realize that shareholder advocacy groups or fund companies are coming into these conversations with the goal of wanting to improve the company and make them more sustainable, more desirable for shareholders and other investors. So they're much more receptive these days. Another question that we get on this is, who actually does this work? Who goes to the board meetings? So oftentimes it's the fund companies that we use, and that's a big reason why we choose those fund companies, because they're active in this way. Not all sustainable fund companies will do this, but the ones that we use, most all of them do. If they don't do it themselves, they coordinate with other organizations. One of those organizations is called As You Sow. They're one that we partner with a lot, and they're called a shareholder advocacy group. And they're not a fund manager; they don't manage money, but they get authorized by people that do own shares, and then they go into the boardrooms of all these transnational corporations and make things happen. So they've been very, very effective at making change. On the right here are some logos of companies that have been pressed, and I'll give just a few examples of these. Disney and Mattel, they got pressured and committed to using less plastics in their vast array of toys. Costco, similar thing. They have a 5-year plastic plan now and a way to wind down their plastic usage in their products, and to a lesser extent, some of the products that they source from many other people. Google and Alphabet, there was an issue about the Chromebooks not having a long shelf life. And so as you talked to Google and they said, hey, can we do something about this? And they said, yeah, we can actually update the software and give these Chromebooks another year or two of life. So that allowed 120 million computers to remain in service, saved taxpayers almost 2 billion and millions of tons of CO2. So when you move these companies, it moves the needle in a big way. These next two slides are some of my favorite because they're personal. These are things that I have seen in the real world, and these are the types of things that are driven by shareholder advocacy and responsible investors like yourselves. So the first one is a sign that I saw in Starbucks, and it said personal cups are now welcome. So I think it's a great idea. You don't have to use a paper or a foam cup of theirs. You can bring your clean cup, get a coffee, and everyone's better off for it. In Costco, I usually buy these tubs of mixed nuts. I was looking for them one day. I couldn't find them. I asked an associate and they said, oh, they're over there in that bag. And I wasn't used to seeing them in these bags. But when I looked at the top corner, that little yellow part, you can see that there's an 85% plastic reduction by just changing the packaging. This is a direct example of shareholder advocacy in action. This is one that I'm sure everybody has experienced. Amazon packages coming in smaller, lighter, thinner packaging if possible. And you can scan the QR code and learn more about it. I did that and got this screenshot. More than 2 million tons of packaging has been avoided since 2015 due to these changes that happen in big corporations. So the effect is real. You can see it out there if you're looking in the right places. So what's next? I think that's something that many people are interested in. This is one of the comments that we saw a lot on the RSVPs. What's ahead for ESG? What do we think is interesting? So number one, the resilience of the sustainable transition. What do I mean by this? I think maybe in a lot of people's heads, there could be perceived a lot of headwind against sustainability. The Republicans in Congress are pushing back against certain sustainable measures. But the bottom line is things are forging ahead. Clean energy is proving to be cheaper than fossil fuel energy in certain instances. Companies realize that and are just going towards what makes business sense. You have changing consumer preferences, societal shifts that are moving in this direction. You've got government stimulus like the CHIPS Act, the Inflation Reduction Act, the Infrastructure Act. All of these things are pushing capital towards sustainability-focused businesses and really bolstering sustainability. So there's a good road ahead, we believe. Second, and I'll drill down into these points in other slides, in the next slides. Second is biodiversity as a core metric to measure sustainability. This has been a really interesting development. Similar to how carbon is, since the Paris Agreement in 2015, that was the main currency of climate change and the main thing to measure, the main thing to get companies to reduce. Now that's expanding into something that is more broad and I would say complex, which is biodiversity. So I'll talk about that in a bit. And lastly, innovations to address social challenges. Social challenges like education, quality of life for longer lifetimes, inclusivity of all different peoples, whether across race, across handicap, across criminal background, including those people in the workforce. Those types of challenges are being solved and addressed by corporations. So back to the first point, the sustainable transition. Currently, it's still a focus on greenhouse gas emissions. So the main things that are happening there are trying to get companies to simply reduce their energy usage or offset it or invest in quality renewables, whether that's on their properties or sourcing the energy that they use from other clean sources. This last one's interesting, linking executive pay to climate goals. Something that not many companies are doing, but it's been a big push. And as you can imagine, if you incentivize a CEO to align their pay with meeting certain climate goals, the incentives match up and things are more likely to happen. So we are seeing that across a select group of companies. Here are two companies that are not household names, but these are the types of things that may be in your portfolio with us. And I just wanted to do quick highlights on them. Aptiv is a company that supplies electronic systems to cars. Most likely the car you're driving has components that are provided by Aptiv. They've been a leader in sustainability and particularly reducing greenhouse gas emissions, working on waste recycling. They've worked with the SBTI, which is the Science Based Target Initiative, to make sure that the goals that they set are really tied to scientific data and are truly meaningful and impactful. And they've increased their waste recycling over the past 5 years. They currently recycle 84% of their waste. Corning, the glass that you're touching on your smartphone is most likely made by Corning. They're another leader in the corporate space, although you've probably never heard of them. They've just been very proactive on greenhouse gas commitments, kind of going above and beyond what shareholder advocates are asking of them. So just two examples of companies that are leading the charge. Also, just a quick diversion slide on the topic of carbon footprint. This also relates to one of the questions from pre-webinar. How clean are the funds that we use compared to their indices? So this is just one of the funds that we use. It's called Parnassus Core Equity. And there it is in the green. It has the carbon footprint is about 50% of the S&P 500. So I think that says it all, that it's truly impactful to invest this way. On to the theme of biodiversity. I like to call it the new carbon footprint. It's still a lot of work to be done here, but it's something that a lot of the fund companies are excited about when I have conversations with them about what they're working on. I mean, just to connect this to the topic of investing, almost any company in the world relies on the natural world for the resources or for some inputs to make their product or service, and then it has some effect on those ecosystems. So the topic of biodiversity is how do you account for those reliances on nature and those effects on nature? And again, more broadly than just greenhouse gases. Estimates suggest its influence on over half of GDP. So as we all know intuitively, the natural world is at the core of our economy and our life ahead of us. A key challenge, we have a lot of clients that work in eco areas, and I'm sure they all are thinking this right now. How do you measure something that's so complex? It's a challenge, but some of the starting points are species richness and abundance, species threat, species evenness, and ecosystem integrity. I won't go any more than that because I'm still a relative beginner at this whole topic, but it's an interesting part of sustainable investing. So on to some social themes. Like I mentioned before, education is a big one, physical and mental health and wellness, inclusivity in the workforce across race, handicap, criminal background. Again, societal challenges, they're so numerous, it's impossible to list all of them, but these are just some that are being addressed by these companies, for example. Again, I'm only showing a few stories on each of these slides, but underneath this, there are hundreds more just like it. So Intel developed a program for education transformation, addressing public education to increase competency across reading, science, and math. The direct result was that schools that had this program, their assessment scores or their kid scores on standardized testing increased by 10+%. Danone, the food company, had a project in Senegal where, understanding that that area had limited access to refrigeration, they developed refrigeration and waste recycling. They developed a milk carton that was composed of local grain that could be stored at room temperature. So that allowed nutritional deficiencies to be addressed, and just a product that fit the environment so that people could get what they needed. Johnson & Johnson underwent a racial audit, meaning they looked at the composition of their workforce, and it's called EEO1 data, and they got an understanding of what the racial breakdown is of the workforce. And they use this data to then drive changes to create targets on where we need to go from here. And I think that's a really important theme to understand, because this happens across the environmental space and the social space. Is you get data first, then you can set targets and work towards those targets. But without the data, without the metrics, you have nothing to go off. So some of the resolutions that are filed with companies are simply to get data and be transparent about data. That's usually their foot in the door to drive more impactful commitments, which is really what we're all looking for. This last one is a coalition. It's not a business itself, but it's a coalition of many large businesses. And this coalition helps companies create structure around employing people with criminal backgrounds. So companies are trying to do their part in creating systems for other companies to do better and be more inclusive about their workforce. This is interesting. There's a few current events happening that I would define as headwinds to ESG and sustainable investing. The one at the top left, to summarize it, there have been attempts to dismantle what's called the 1984 Chevron case. That is a very important case in law because it really gives agencies like the FDA, the SEC, the EPA, it gives those agencies power to set and enforce rules without having to go through Congress. It would be too slow to go through Congress. The experts are at these agencies, so it really was put in place to provide efficiency. There's now pushback against that, and it's really trying to take away that ability of the FDA to approve a drug, or take away the ability of the EPA to protect a river, which is really poses problems to ESG, because it then puts the responsibility solely in the hands of corporations, which if it's just left to them, there could be trouble there. Another item is there's pushback against ESG activist groups like As You Sow to try and disempower them or say that they're not allowed to go into boardrooms and ask for these changes. So I think the common theme with both of these is they're trying to restrict rights. They're trying to restrict rights of agencies to make intelligent decisions and enforce them. They're trying to restrict corporations from putting out data that is helpful to assess risk. So these are things that we very much don't agree with, but it's part of what's in play right now in this space. I think it's interesting that sustainable investing is just going to forge ahead. I think this quote from Winston Churchill sums it up well, that it will just continue. And it's really the markets in the world are wanting to see this more comprehensive risk assessment that ESG provides. Is really the intelligent direction. Just like when you invest in a company, you want to understand their financials, you equally want to understand what their footprint in the world is. So the markets have really been speaking on this, and the results of that are that companies with diversity of workforce, they tend to outperform. Companies that reduce controversy are going to have less legal costs and will be more successful. Companies that reduce externalities and take care of the world, they're going to be around longer. So I think all of our clients intuitively understand that, but we hope that message makes it out to many other people. Back in 2019, there was a collection of 200 of the largest CEOs of the largest 200 corporations. It was called the Business Roundtable, and the goal was to redefine the purpose of a corporation. For so many years since Milton Friedman, the sole purpose of a corporation was just to produce value for the shareholders. That really needs to be expanded. We need to take into account more things, more people, and that's really what the goal of this meeting was. So I'll end it with a quote that sums it up well. Companies must realize that the success of our system is dependent on inclusive long-term growth that values people and planet along with profit. So that's really what we believe in. So I want to kind of reframe this in the context of a client story. I think this is helpful to just walk through one of our clients that we work with and how we helped incorporate environmental and social values into their investment plan. So these are clients that we've had for 20 years. They have a foundation whose goal it is to empower the poor and end war. So to address that, getting into investments that screen out weapons companies, guns companies, military defense companies, that accomplishes that, funds that push for corporations to progress. So using mutual funds that are advancing corporate sustainability and pressuring companies to be better. And then the companies in those funds are ones that support and invest in human capital more so than their peers. We found out over time in conversations that they're very interested in community level investments. So things that are more, I would say, grassroots or not, not like public companies. So we found securities that were not widely available that focused in supporting these types of organizations. And these types of organizations had environmental and social business models. And lastly, they're very interested in clean energy. So it's the same fund that Alan mentioned in his portion. We have this fund that invests in clean energy real estate. So investing in solar and wind farms that are producing energy to sell to utilities. So we got them invested in that, which is a great match for their clean energy focus. Where they live, they can conceivably drive by locations that are part of the investment and actually see their investments at work in this way. So we think it's cool that just one client can encapsulate so many parts of this conversation. So I'll end with this slide. When I talk to some clients, they say, Robert, it just feels so uphill, everything going on today. And if anyone out there feels that way, I first of all want to say I understand. I could see how that's possible, but I think it's imperative in light of that to bring everyone's focus back into what is the big picture goal of sustainable investing. And I think the ultimate goal is to make the world a better place. And it's important that everyone realizes that you're part of this. You're part of this solution. Being a sustainable investor means you are voting with your dollar. So I want everyone to leave with that. Secondly, there's some great organizations out there that are really allowing people like you to get active in climate action and sustainable finance. Get your feet on the ground if you would like to. That can help people feel more involved in the solutions that they want to see. So Third Act is an organization headed by Bill McKibben, and it's one that a number of our clients are involved with. So just doing a little plug on them. For anybody that wants more information, feel free to reach out, and happy to provide. So that sums it up. We are right at time. I have just 2 questions from the crowd today that I want to address before we sign off. One of those questions was, what are trends in ESG and quality companies? And I think the big trend is that companies want to do this for themselves. They don't just want to do it for shareholders. They do it because they understand society is moving this way, customers are moving this way, it can be more profitable, and you have younger decision makers at the company that really believe in this. And so it really can come from the inside out sometimes. The last question from the crowd was how changes in ESG affects decisions. So for instance, at a certain company, what if their governance score goes down, if they have conflicts with their board of directors that people might see as troublesome? Well, we really leave those decisions in the hands of the fund companies. A perfect example of this is Tesla. I've had conversations with fund companies who said, you know what, Tesla may be good financially, but we ultimately won't include them in the portfolio because of some governance issues and conflicts of interest with who's running the corporation. So the fund companies are constantly looking at the ESG profile and incorporating those changes into their decisions to include or exclude the companies in the fund. So with that, we are right at time. I want to end promptly and respect everyone's evening. So thank you so much for joining us. We hope you got a lot out of this, and we really appreciate everyone making the time for this.
Thanks for joining, everyone. Talk to you soon.
Take care.